record the. It says recording in progress. I probably don't need to start it. Good afternoon, everybody. Webinar shenanigans as normal, but yeah, last time we didn't actually record properly, so we're going to go ahead and do that now, hopefully. But for those of you that are here, you'll obviously get it live. Put stuff in the chat, put stuff in Q&A as needed. And we have some teammates, my trusty partner, Ben Von Drack, and I believe Matt Stanford standing by to man some of the regular chat so I can keep rolling. And I will stop from time to time to take some questions. But yeah, let's kick it off. Stand by. Slideshow. First, I better start showing screen. Let's do that. Entire screen. Share and slideshow from the beginning, and let's do it. All right. So really, there's going to be three parts to this webinar. It's mainly the 2026 Infinite Banking State of the Union. I realize we did do it 2 weeks ago, but there has been some updates. IBC, Infinite Banking, is a timeless strategy, but the economic environment is different. And that was actually, we've been reviewing Nelson Nash's original book in we call it book club. It's something you just opt into on our site via email, and you get sent email commentary about myself, chapter by chapter. And the environment, Nelson Nash really stressed that it's not just about the underlying vehicle, but controlling the environment around you as best you can. We're going to talk a lot about AI. AI is here to stay. That is disrupting the economy. It is disrupting the way a lot of people work or don't work. It even disrupted our business in terms of most people would find us via search engine optimization. All AI models, be it ChatGPT or Claude or Perplexity, they're called LLMs, large language models. And we had the most written content out there. And so a lot of you, when you were researching infinite banking, there'd be some ads and whatnot, and we would be up at the top or near the top and had a lot of good transparent information. That's at least what a lot of you told us, that you guys liked our information because it was so detailed and transparent. But nowadays, people just go to ChatGPT and it summarizes it. It actually trains itself on infinite banking with our data. We've seen that with different softwares, but it doesn't always cite us. And it isn't always correct. That is the main thing that I learned. ChatGPT is a very frustrating model, but we're going to talk more about that later. And last, transforming New Year's resolutions. I realize we're at the end of January. Some of you may have had New Year's resolutions and they've subsided. I'm down about 7 pounds and I'm not doing anything crazy, but just trying to anchor some new behaviors to old habits, to shift behaviors, just like we're trying to do with money, just compound on a daily basis, trying to do that with some habits. So I'll share some tips, tricks, and how to use AI to help with that. So inflation has not been tamed. We're going back to the infinite banking State of the Union. I think this is probably the biggest story. Because inflation is they cook the books, right? It's a select baskets of goods and service in select cities, and what they can't cook the books with are Costco frozen hamburger patties. And so this is my measure of inflation. I remember talking to my wife; she got so tired of hearing about it, but like we used to get these, call it pre-COVID, even early during COVID, that middle stack there, and this is not my picture, I got this off Reddit, that middle stack, the ground sirloin patties, those were the best because they were like actual steak. In fact, like there they are again, this is Reddit, you can see like how pink, like that's a lot of steak. But those things were about $18-19 for a stack of 18 of those bad boys, so about a dollar a patty. Now they had the ground beef patties, which you can see they're the same size, a third of a pound. You see it has a little less protein because it's a little more fat. You can see it by the picture too. They're still good burgers. In fact, that's all you can get. Unfortunately, you can't get the ground sirloin anymore because of something called shrinkflation. So shrinkflation is still inflation. Costco is all about low prices, and so they didn't want to kind of like put it in people's faces how bad inflation got, but it got bad. Like essentially, you can get the blue burgers now for between anywhere from like 32 to 35 bucks for the same thing. You used to get those blue burgers for like 16 or 17. So like literally doubled. And before inflation really reared its head, they came out with those grass fed. Now you can see the number 15, they had less of them. So that also is shrinkflation, but like they're grass fed. So whatever, they're supposed to be better for you. I think the sirloins were way the best. You can't get the sirloins anymore. All you can get is the grass fed, and they're the same price as the blue burgers, but you just get less of them. You get 15 versus 18, and it's just crazy. Um, Moving on, the year of 2000, that was when the dollar was at the strongest. So if you look at that far red blip over on the right, this is the price of gold, which back then it was $260 an ounce. You can see when this is like the history of all gold futures. When we got off the gold system and the future started, the price of gold went down against the dollar, which meant the dollar was strengthening. But then we had hyperinflation, right? And things cost a lot. Things like oil, things like gold that fall on your foot, things like burgers cost a lot more. And so the price, one could say that the price of gold went up. But the other thing they could say is that the value of the dollar went down. And that's what happens when you get off the gold standard and you start just printing paper. Like my kids understand supply and demand. You print a bunch of paper and everybody has more paper. What happens to the value of that paper? It goes down. What happens to the stuff where it's limited and only so many people can buy it? Well, people are willing to bid more pieces of paper. And that year 2000 happened to be the year that Nelson Nash wrote his book, Becoming Your Own Banker, Unlock the Infinite Banking Concept. And cash was king then, and the almighty dollar it still is the world's reserve currency, but obviously there's been a lot of talk about BRICS nations and people getting off the dollar. And nowadays we're not at 260 gold, we're at 5,000 gold. This is an old chart. You can see it goes up to 4,600, right? But gold is well over 5,000 now. And this chart I showed in the webinar 2 weeks ago or whatever, it's crazy. So is this gold? Is it a bubble or is it a canary in the coal mine? Just showing the market is sniffing out, the market is a leading indicator and it's sniffing out that the value of the dollar is going down. What time will tell. Oh, there it is. There's my new picture. There's gold at 5,000. That's the old picture. And it's just screaming. At any rate, let's move on. So I put expect turbulence. So this is just a tweet that came out. You can see this guy, he's a cool follow, this finance Lancelot. I call it bear porn. He seems to be kind of a perma bear, but it is worth noting, what he's saying is that the Dow Jones to gold ratio, the amount, the units of Dow Jones that every ounce of gold can buy, right? Or put another way, the amount of ounces of gold you can get for one Dow Jones index, it is bubbled, right? And that's what we're experiencing now in 2026, 2008, 1973, 1929. So again, is this a canary in the coal mine? I don't know, but he also brings up these treasury bills held by the Federal Reserve. So when the Federal Reserve is buying treasury bills, that means they're injecting cash. They're printing. The money printer goes burr. They're injecting liquidity into the system, and they usually only do that when there's trouble. So you can't see down here, but this was 2008, 2010, right? And now it's climbing back up, and it came back down. This is around COVID 2020, and now it's climbing back up. So is this dying canaries, or is this just standard operating procedure? Nobody knows. What we do know is that cash is trash, and that the Fed's hidden tax is what isn't confiscated by taxes is confiscated with inflation, kind of like with those burgers, right? They're not overtly taxing you, but they are covertly robbing you of purchasing power. And this is actually a tweet that the Federal Reserve put out where Jerome Powell said he wasn't going to cave or back down to Donald Trump, and that, they are meant to stabilize the dollar. Keep up the good work, not who knows? But, Nelson was very, very critical of the banks and banking and the Federal Reserve. I don't know. They say it's designed to stabilize things, but the fact of the matter is since its inception, around the same year that the income tax coincidentally or not, was created in 1913, the dollar has lost 98% of its purchasing power. And so what we say is, if you can't beat them, join them. And what I mean by that is the message behind the infinite banking concept book was to get off the banking grid. Well, like that hasn't happened. That never happened. You can't do that. Like when you pay your premium to an insurance company, they're not going to accept smaller marked bills. They're not going to accept Bitcoin or Ethereum or silver or gold. You have to pay with cash, and you have to pay with cash from a bank where you're identified, and your cash value grows. And obviously, if you take a loan, they're going to take money from their bank, their general account, and send it to your bank. So there's no getting off the banking system. And so unlike a lot of the philosophy out there, which still says, and to me, this is kind of what I call infinite banking Old Testament, like get off the banking grid. Like even the Bitcoiners, they still have to find a way to convert Bitcoin to cash, and you have to do it through a bank. And so what we say is, if you can't beat them, join them. And so use banks for what they're good at, and use the different tools as not just banks, but investment banks on Wall Street. Use the different tools, not only just growth options, because they're obviously, the Federal Reserve was designed to benefit that system. So there's some natural tailwinds there. Obviously, there's volatility, and that's why we get policies to cushion against that volatility. But there's also conveniences. There's also better loan rates a lot of times. And so that's what we're all about. And this was just not well timed. But The Creature from Jekyll Island was a book that talked about that the Federal Reserve was created by, and this is like documented, like a bunch of bankers went and like disguised it as a hunting trip in Jekyll Island in Georgia, I believe it was. But really they were secretly meeting to create the Federal Reserve. And again, it just happened to coincide when the income tax was developed. So we're getting our wealth now confiscated overtly through taxation and covertly through inflation. And the bankers, meanwhile, the same bankers that Nelson Nash raved about are getting rich and kind of front running everything because they control it all. So how do we, if we can't beat them, join them? How do we do that? And so we came up with something called 4D banking. And it basically says, if borrowing against whole life works so well, why stop there? I understand you could have this philosophical stance, but you're not getting off the bank. So if we're still operating within the banking system, why not use all the tools available? Now, I realize that unlike Old Testament IBCers, that will cause us to sell less insurance, right? Or smaller policies, like if there's other options. But we believe that when you combine, and that life insurance should actually be the cornerstone, when you combine it with other compounding assets and loan types, you can create the best of all worlds. And so this is just a screenshot from way back when I used, like at the time was my biggest IBC purchase was to buy a very illiquid RV, take my family around the country. I could have gotten an RV loan. It was kind of expensive money at 8, but at least it was going to be collateralized by this big hunky money pit, right? It's kind of like a boat, bust out another 1,000, like it's a land yacht. I could have collateralized it against that, but I wasn't able to move with speed, and I was able to get a deal about almost $20,000 off by paying cash through a private party. And so I decided to jump on that. And I used not only my life insurance loans, because I could borrow at 5 or 8 at the time. I had some IULs that were locked at 5 or 6, but I was also able to use a cash value line of credit at 3.5. That throughout that trip actually dropped to 3 because interest rates are dropping. But I was able to get a margin loan at 1.8%. Now, I realize in a vacuum, borrowing against stocks, taking a margin loan is risky. And it is. You can get wrecked because assets are volatile, and you always have to maintain at least 2x the amount of assets to the size of the loan. And if you're upside down, if you're underwater, unless you deposit cash that day, they're literally going to start liquidating increments of your positions to make sure you're in compliance to that loan to value. And so I don't recommend borrowing on margin like in a vacuum, because you can get wrecked. Like assets like, the S&P has lost, up to 40% in a year, and that's 40% calendar to calendar. Like just in 2000 and 2008, or excuse me, between 2000, 2003 and 2008, it lost even like the Dow Jones, which is more conservative than the S&P, lost over half of its value from peak to trough. Something like Facebook, it's screaming now, but we saw it, drop from, almost $500 to under $100 in the period of weeks when the crypto bubble crash and Mark Zuckerberg had gone so strong into the metaverse. It's obviously come back, but had you been borrowing against Facebook stock, you're going to get wrecked. But you can do it if you have the sanctuary of something like whole life where it has to go up. And unlike margin loans where you can only borrow up to 50%, and I don't even recommend that, right? Like maybe 25% a loan, and even that's a little risky, but as long as you have backup. But by doing that, at least you have time, because your, call it $100,000 account could lose 50% of its value down to 50,000, and you'd still be in compliance with the $25,000 loan. Maybe you can get a little more aggressive or whatever and take that cheaper money, take that margin loan, knowing that you have the backup of whole life. Home equity line of credit can be a great backup. Like obviously there's risk to borrowing against this sanctity of your primary residence that your family lives in. Like people have emotional attachment, but it's a dead asset. It's brick and mortar, but you can convert it to liquidity. And again, we don't recommend just doing it for nothing. But if you can use that to leverage into other assets or businesses or real estate deals where you have more knowledge and control and can get positive cash flow, that can be a great thing. The 401k loan is down there. That you can only get about 50,000 per person, and you need to have $100,000 account. But we have a lot of people these days. I don't know what agents are recommending. Like we're getting this a lot where it's like Old Testament IBC advisors are saying cash out your 401k and then put the money in policies. And so if you have $100,000 account, if you're in California and you're in one of the higher tax brackets, you're only going to have $50,000 left, right? Or you're going to owe 50,000 in tax. So for me, why not just borrow against 100? And at least I have the free roll of the other 50 that's working for me. I understand it could get taxed later in the future due to Jekyll Island and taxation and everything else, but at least I have something. I have an asset there, right? And if I really, really, really need it, like in total emergency, even before I'm 59 and a half, well, I'm probably not going to have a tax problem to go ahead and pull from that if I need it. So having additional assets, IBC Old Testament guys will say, like, it's just a horrible thing, never do it. But to us, it's just another tool in the toolbox. It can be overused by the general public, but in a cohesive 4D banking system, it can be valuable. Precious metals. If you go back to some of the early recordings on 4D banking and at the end of 2022 and early 2023, I was screaming from the hilltops that silver was undervalued. It was in the 20s to 30s. Here we are north of 100, all the way up to 117 at one point. Feel pretty vindicated, but I actually stacked so much to the point where I was uncomfortable keeping it in my home, and found there's a couple operations that will lend against it. And so I was able to store it in Las Vegas, store it there and borrow against it when I needed it. And there were times, because I was investing in the stock market and there was a lot of volatility with Liberation Day and everything else, I felt comfortable knowing I could borrow against that. And sometimes I did borrow against that. It wasn't the cheapest money, but since it was just otherwise a single use asset sitting there, I felt very good about it. Emergency funds. Here's a dirty little secret about infinite banking that a lot of bankers won't tell, or IBC people won't tell you. Like, it is written in all the contracts that the insurance companies can take up to 6 months to process your loan. Would they? Probably not. Has it happened in the past? Sure. In the Great Depression, when there were runs on banks, and even though insurance companies were the ones that bailed out a lot of the banks, there was just so much fear in the marketplace that there were runs on insurance companies. And so to protect their own solvency, that's why they build that in there. Now, that's a little scary. And so I don't recommend keeping a 6-month emergency fund in cash. Why? Because of what we talked about. Cash is trash, right? And you're just slowly, like, you have FDIC insurance. Sure, all that means is they're going to print more money and make whatever's there less valuable. But I understand it makes people feel safe and comfortable and they get it. I started my silver gold stacking by just saying, like, look, if there's a real emergency, this stuff that falls on my foot will be more valuable than paper that they're going to be printing out of thin air. So I'd rather have my physical emergency fund right there that I can go swap at pawn shops. There's a number of places online you could just sell it to, or whatever, barter, whatever, if we have end of days. But to me, that's always been my ultimate emergency fund. I don't think any of the carriers I'm dealing with, because I'm dealing with the true mutuals, top tier companies, but you never know. Like if for whatever reason there's a delay in getting that liquidity, I have that physical emergency fund. And I actually have a place vaulted in Vegas, a place vaulted about 40 minutes up the road in Huntington Beach, and a little bit in my safe just in case I need to barter or whatever. So that was a lot, but I already said this, borrowing against volatile assets too risky, but not paired when backed with the stable backing of life insurance. So like that should absolutely be the backing because everything else we talked about is volatile. Life insurance is the only one you can do 95% loan to value and not worry about getting liquidated. Not to mention it just keeps compounding for you in a tax sheltered environment, propping up death benefit, probably chronic illness benefits, and so on and so forth. Just the awesome cornerstone asset to really back this whole cohesive system. Let's see. Yep. All right. So before we go on, let me just jump and see what we got. Yeah, somebody talked about reverse mortgage. Yep, that's possible. Economic repression. Yeah, feel you there. All right, so let's move on to the second part of 4D banking, and that is loan options. So the headwind tailwind analogy, this is that environment I was talking about from Nelson Nash's original book. And he used the example of like so many people are trying to get their plane. He was talking about an old prop plane to go, 100 miles an hour, 105 or whatever. Most people in this situation concentrate all their attention on trying to make the airplane go 105 miles an hour. They would do well to spend their energy instead on controlling the environment in which they fly. You can't do that in the airplane world, but you can do that in the financial world. You can do that by controlling the banking equation as it relates to you. So yes, the policy will give you the most control, right? If you have non-direct recognition loans, and I have a whole video about it at bankingtruths.com/direct. Like obviously there's types of loans where you earn whatever you still earn and the loan will not affect your dividends. However, that loan fluctuates. And so in the 80s, Nelson even talks about how some of his floating rate loans for real estate got so high he couldn't afford it. And that may or may not happen in these policies. Direct recognition, obviously you can control that and better protect. I'm not advocating for one versus the other. We're brokers, we sell them all. But what I like is, again, having multiple dimensions of assets compounding that we brought up, like not only insurance, but the stocks, ETFs, mutual funds, whatever, the real estate backing the HELOCs or rental properties, right? The 401k is a backup. There's still mutual funds in there that if you just cash it out, like you got nothing working for you, but to borrow against it, you do have something working for you. Even gold and silver. And obviously there's a number of other private money loans and whatnot. There's not a ton of liquidity there, but different growth rates. But I'm talking about the stuff you can borrow against that I mentioned. You have all these growth rates, but then also their loan options. And by having the different dimensionality, now you can shop and pick and choose what is the most favorable loan rate and loan parameters, or maybe you are going to take the higher loan rate, but you want to go ahead and use the liquidity from a single use asset like the primary residence or like gold and silver, so you can keep your capacity alive in your policies. So these are all things that we're going to be modeling out in AI, but that to me, this is what I can control in my environment, not just the policy, not just the stock embedded policy loan, but all these other options plus cash value lines of credit. And so for me, it's a constant flow chart of what am I trying to solve? Am I trying to solve for the lowest rate? Cool, I can go to that. Am I trying to solve for the most capacity? I can solve for that, right? Or I can do a blend of all three. But to me, that is the ultimate in controlling my analogy. Life insurance provides my stability, right? Whole life gives me the guaranteed growth from the PUA death benefit. And it just like the more death benefit I have, people say, I don't care about it, but it pulls up that guaranteed cash value, not just from the original premium, but from all that overfunding that is obviously going to go straight to PUAs. When you add PUAs, it raises not only the guaranteed cash value, but the guaranteed death benefit. And so something you want to look at and why we're making AI tools is so you can test that and see how efficient those PUAs are within the policy. IUL gets a very, very, it's a dirty word with Old Testament infinite banking, with most infinite banking concept people who sell it, practitioners, whatever they want to call themselves. But the thing about IUL that I do like in addition to the fact that I do get a better growth rate when the market goes up, and I know there can be multiple down years. I know everybody's been saying the market's due to crash, but again, going back to if you can't beat them, join them. Remember, the whole system is designed to prop up Wall Street. Well, if you're concerned for people that are too scared to have, call it raw, unfettered, volatile access to the stock market, IUL can be a great way for them to maintain some equity exposure and reduce their risk. It's not as let's just say ironclad as the guarantees of whole life. I would never say that. But in terms of a risk adjusted return, if you design the policy properly, like you're seeing in the picture here, where you design the death benefit to shrink wrap around the cash value so that you pay less fees, contrary to what most people say about IUL in the infinite banking community, there is a rising cost of insurance, but that's rising per unit. So the cost per unit of insurance does go up as you get older. True story. But if you design the policy properly, the amount of units or insurance you're paying for will go down to the point where we're seeing after year 10, you can get the cost of IUL down to like Vanguard funds, certainly cheaper than retail mutual funds, or paying an advisor 1% to manage retail mutual funds. And so to now have that equity exposure, that can be beneficial. And again, I got my first IUL in 2014. I think there's been 3 down years since then. And obviously it depends on what month you're talking about, month to month. But for the most part, if now we're talking 8 for the last 11 years going on 12, if 3 out of the last 11 go down and 8 of the last 11 go up, that's a winning formula. That's one aspect. The other aspect, like I said, it's not just what's compounding in your behalf, but it's also shopping loans. If we have hyperinflation, or should I say, when we have hyperinflation, whether gold's telling that story now or it's just in a bubble, but when we do have hyperinflation again, all those non-direct recognition loans are going to get out of control. All those HELOCs are going to get out of control. All those margin loans are going to get out of control. So you either have direct recognition whole life to help protect against that, or you have IUL where there are locked loan rates that you can get today in the 5 to 6% range. And obviously they'll give you a different growth, call it regime growth strategy around that. But there's still the opportunity to get that positive arbitrage, maybe 0 to 10 with a 6% loan rate or something thereabouts. And if you look at the math at the S&P historically over the last 80 some years, will go up will go up 3/4 of the time and down 1/4 of the time, similar to my 8 and 3 analogy of my last 11 years or my experience personally with IUL. That is a good, that's a great place to be able to hedge against rising loan rates, to have a pocket of money where you can control your loan rate there. What else? Both provide tax advantage growth, uninterrupted compounding, and both of them, like, this is just amazing. No other asset can you borrow 95% loan to value. Even the gold and silver, they'll give me 75, but I don't push it to 75. And even if I really needed the money, I would not want to leave that little cushion in there. But with life insurance, you can. Before we move on, let's see what's going on. Yeah, so Logan says, I don't have a dog in the IUL versus whole life fight, but I just don't understand why you'd want to tie your cash value to a Wall Street created metric. Never made any sense to me, not saying it can't work though. So Logan, yeah, I think I answered this before, but to me, it's about diversifying the growth of the entire banking system. And like if you had done even through the lost decade, IUL, and provided you would have to go through a company that didn't squash your caps or didn't like increase your fees. And none of the reputable companies have increased the fees. Several have lowered their caps, but assuming you got fair rates, they have outperformed whole life. I'm not saying you should do it in place of, but I think that's some of the thinking we want to get away from. And most people are in an either or mindset. And for me and for clients who have means where it's not an either or conversation, like I'm either going to do my 401k or whole life, like they have, you want to diversify not only your asset growth, but also the loan type. So like I said, it does bring up a unique loan type. And I think even though it is a Wall Street created metric, again, going back to the creature from Jekyll Island, and the thing that Nelson Nash hated, and I'm not a big fan of. Like they say, don't fight the Fed, right? It's like there are tailwinds there that philosophically, if you were against it, that's fine. But there's been an opportunity cost from not having some footing in their products. Let's move on. Okay, so let's compare loan rates across. These are just the whole life companies. I'm going to need to put a charger on this bad boy. So let's do that. Yeah, so as of today, and if you're watching this in the future, this ebbs and flows. So this is Penn Mutual's loan rate. They are direct recognition. I realize a lot of people don't like direct recognition, but mainly just because they're parroting what they've heard from other people and they don't really understand it. So I'd encourage you to look at bankingtruths.com/direct. Mass Mutual, they are True Mutual too. 5.33 non-direct or direct. So this is interesting. They actually allow you to choose non-direct or direct irrevocably at the start of the policy. These are the top two performers, like hands down. Nobody could argue with that. In fact, show some AI tools here in a little bit where it'll really just get to the heart of the banking truths. But yeah, these are the these are the neck and neckers, if you will, the top one and top two. But what's interesting is it's interesting to see what people buy themselves. I'm saying the agents. So I have I have more than three Penn Mutual policies, but I have three Mass Mutual policies. And all of them, I chose direct recognition. And I remember agents, I remember even the brokerage, the guy at the brokerage telling me I'm crazy, I got to choose non-direct, but I wanted to be able to control my rate of borrowing since that's what I was doing. And I was trying to get alpha outside on the outside. So I was more concerned about controlling that variable that could get out of control for me. And I feel vindicated. New York Life, they actually have, believe it or not, New York Life has the highest early cash right now. It's been Lafayette Life, a couple down historically, and Lafayette's right there. They have very, very high early cash. But New York Life actually now has that. We can design it to where they have the highest early cash, and they do outperform Lafayette, but neither of them perform Penn or Mass in the long run. Guardian Life, 6%. They are direct recognition. They have a unique thing where at the end of year 10 and year 11, you can irrevocably switch to non-direct recognition if you want, but then it won't be a locked 6% rate that where you actually get treated fairly on your dividend. It'll be a floating rate like that we talked about. And then Lafayette Life, they are a mutual holding company. It's worth noting, if you don't know the difference, go to bankingtruths.com/mutual and learn the difference between a true mutual and a mutual holding company. Their loan rate is 6.5. They were as high as 7, but now they are 6.5. Again, we put them on the list because they historically have had the highest early cash value, but again, New York Life, with their recent dividend raise, now has the highest early cash value. So let's take some questions, and then we will do a live look at some policy analyzing. Let me take a look here. Yes. Okay. Yeah, I'm just going to move on. There's some pretty technical stuff. Looks like from agents. Good stuff, guys. Probably beyond the scope of this call. Before I get going on this, let me just talk to you about what I'm building, because this is an update. Because the first time I did this, I really wasn't sure where I was going with it. But long story short, in fact, I'm just going to stop the share and we'll talk and we'll just go back to it. Yes, I'm full screen. There I am. Okay. So in 2018, 2019, we started something called the Banking Truths Brain Trust. A lot of the agents on this call may remember that. We were doing training, and we also started building software. It was a real headache because we were doing it through India. It started off cheap, like $10 to $12 an hour. Then it was like 15, then it was like 18 to 20. But that wasn't even the worst part. The worst part was to communicate with these guys. I had to make them videos like I do and just kind of talk through them, but there was a language barrier. So then when they just weren't getting something, like you go a day and they do something that was wrong, you try again, the next day is wrong. You get on the phone, and I have to get on the phone at like 5, 6 in the morning. I like to sleep in, wake up when my body tells me, or I'm doing it like midnight, 1 o'clock. They're just waking up. Like it was painful. But we made some pretty cool calculators, like really custom borrow situations. And to me, that's what's really lacking in the marketplace is full bespoke custom. Like, does this really work? And if so, how well? Because there's a lot of talk out there of like, hey, get your money working for you, right? Like, just slam all this money into policy and then borrow against it right away. And you know, it sounds great in theory, but when you do the math, especially if the policy is poorly designed or if the loan rate is greatly above the dividend rate, we're finding on a regular basis that when because we've asked clients, and if you're a client, you want to have policies you've looked or been shown analyzed, or loans you've been shown analyzed, or you want to just walk through a situation, send your stuff over. We're happy to do it for free still right now. But we're finding those people would be better off just like never touching infinite banking and just putting their money in a coffee can, putting their money in a mattress, right? When you get up to like medium design policies, like it's probably slightly better than a savings account. And there's obviously all the benefits of death benefit, perhaps chronic illness, creditor protection if you're in those states, everything else. But if that's not valuable for you and all you're concerned about is how much better is it than something with a similar risk profile, which would be a savings account, we're finding that most policies are kind of very cuspy right there, but we're just taking all the opinion out of it and just doing some true math. And then the best design policies, they are better, like clearly and genuinely better, and we're able to test that and prove that not only with just words and philosophy, but also with math. And we're using AI, so it's great. Like, we're having it show all its work. So if somebody wants to see how the clock is built, cool, there it is. Somebody just wants to know what time it is, cool, here's the chart. We're going to look at that in just a little bit, but I was wondering whether or not I wanted to make this available to agents again. Like, we actually did get all our old files and we dropped them into Claude Code and said like, hey, fix this, make it work again. Let's give us like zip files and coding stuff to put it and host on a website. We got it working. It was pretty cool. With $100 account, we didn't even use all of the bandwidth within a week and lots of iterations. And then we started improving upon it like greatly. Stuff that was taking me like 3, 4, 5 days back and forth, I was like doing while I was going to pour my second cup of coffee. Like, AI is amazing, incredible. And people say we're in a bubble. There will be volatility, no doubt, but people have no idea how incredible AI is. So for me personally, in my 40 banking, part of it is trying to build a stock portfolio with some of these companies that I think are going to be leading in the future. Obviously, there's some risk there, obviously some volatility and everything else. But since I have the other components of my banking, I have the ability to create a much bigger bank if my thesis is correct. I digress. What we decided to do with the agents is, rather than host and charge membership fees, because it's like, if you're an agent out there, it's like death by 1,000 cuts. Like, everybody, I shouldn't say everybody, like there's already half a dozen different softwares. And like, the problem is like, one software doesn't do everything. Like, the closest thing to that would be Circle Wealth, and they're awesome. Like, I still subscribe, but they don't do everything. Or like, some of the things they do, I wish they did a little bit differently. I remember talking to Don Buddy, like, could you guys just do this and that and the other thing? And they actually took some of my suggestions. This is like early on, like 2011, 2012. But obviously, like, the devs like have their own timeline, they have their own roadmap, they have their own whatever. And as advisors, it's like you have your kind of one main squeeze, and you wish it would be like customizable, or the reporting was a little better. And then you have like these 3 or 4 other softwares just because they do that one thing you like. And it's like, what if like you could just show whatever you wanted to show whenever you wanted to show it in a way that was customizable to whoever you were showing it to? Well, guess what? It exists. It's called AI. AI can be garbage in, garbage out, right? But when driven by somebody who knows what they're doing, and you quality control it, one quality controls it, I should say, you can produce some amazing stuff. And that's what I'm going to show you here in a moment. So that is going to be the business model. The business model is we're going to do some info products and coaching around it. So if you're interested, the website is not even up yet, but it will be soon. bankingtruths.com/AI, artificial intelligence, advisor, incubator, agent, incubator, whatever you want to call it, which is kind of cool because our old thing was BTBT, the Banking Truths Brain Trust. This is going to be AI. So let's see if I can kind of show you guys some stuff that I did today. Well, let's see what I put on the slide. Oh, so one of the things I'm going to show you, I call it atomic policy because it's like splitting atoms, right? Like we're isolating the debits and the credits. Unpack the true cost of any policy, the early missing equity, and then isolate your hurdle rates. Like, so I bring this up because it's like this, like everybody's so worried about high early cash. Like this has the highest early cash. But I say, you know what has the highest early cash? Cash. like if that's what you're trying to solve for, just do cash, right? It has 100% early cash. Amazing. Why don't you do that? Because cash is trash and it's losing value, and banks and high yield savings accounts give you crappy rates of return, and then the government wants their tax, and you can't really borrow against it without going upside down, so you have to spend it and replenish it, and you lose the compounding. That's why you don't do cash. So why you put money in a policy and why you're willing to have some amount of early cash that's less than what you would have in cash is for long-term benefits, long-term growth, and possibly some ancillary benefits. Not everybody cares about the death benefit, but everybody cares about the tax savings. So if that's what we're trying to solve for, why is everybody looking through the lens of early cash? I don't know. So, by the way, we have a borrow thing too. That is the loan amount. Stand by. Hold on. Let me get queued up here. Sorry, everybody. I don't know if there's questions that I should be addressing while I'm doing this. All right. So I did this today. We got an email, and he may be on this call for all I know. So yeah, he said, hey, I was shown this policy by a mutual holding company. It was One America, but I made this, I made it so it was, what do you call it? Yeah, I made it so it was the report, so it was just not naming names, but whatever. So anyway, here is the analysis. Let's move this out of the way. Let's expand the screen. Whole life policy analysis for Jason J. Whole life insurance is often misunderstood because it's seen as one, two things: an expensive alternative to term life or a lackluster alternative to investing in the stock market. As agents, we know the difference. If you're a client, you want one of these analysis, we're happy to do. Agents, we're happy to just not only show you how to do it, but all the files I use to make this, I'm going to upload it into your machine or give it to you to upload into your machine. So with any whole life policy, we can easily see how much of your premium shows up immediately in the cash value to grow. So like that's just apples to apples. Like how much of the yearly cash goes to cash that you can use, and how much of your premium goes missing from cost, fees, and commissions. And so here it is, Jason. It says North American, but it is actually One America. We just uploaded the policies. Here's his age. Here's the retirement year, 15 years later, 35 years life expectancy. We asked for the state tax rate in Montana on top of 24. It gets us 29.9. I'm the agent. And I said, I want to start with the cash value first. So like, again, splitting atoms. We can look at the costs and the fees and what they do, or we can it's not just the costs and the fees. It's not just how much cash is not missing. Yes, we have to measure that. But what is the efficiency of the cash that is left? And that is missing with most infinite bankers. And that's because they want to sell crap policies. So here's the cash value analysis, IRR and total premiums. This is standard. Like this is not imagined. This is what everybody does. So I do it too, right? And so we just go nominal, right? Total premiums paid over 35 years, 241. You end up with 482 cash value. Study period, it does an IRR calculation, 2.66%. Who cares, right? If you consider that in a 30% tax rate, it's 3.79. You might as well just be in high yield savings. Like really, why add all the complexity? Unless you do care about the death benefit, and you probably should, chronic illness, creditor protection. Okay, cool. It's a wash, right? But we haven't tested the borrowing. But this is the other thing. This is not the fair way to measure it. You have to show year by year what's happening. And year by year, you are not getting your money working for you. Right? You put in 90,000, 82 is not working for you. It's a front loaded policy. So the next year, only 812 goes missing from his 6750. The next year, only 480 goes missing from his 6750. The next year, 123 goes missing from his 6750. And then the next year, he's finally starting to be cash flow positive to the tune of 0.23%. Who cares? Right? The taxable equivalent is 0.33. Who cares? We get up here and it's like, okay, it's because there's a massive term rider on this thing to fit the 90K. So it's just a crap design. Once you drop the term rider, it's like, okay, now you're cooking. You're getting 3.65 nominal, and the taxable equivalent is 5.21. All right. Like, that's not bad. It only took you 10 years. So I want to see the year over year. So now if I go to borrow against my policy and I realize there may be a reason to borrow against your policy anyway, and you still get these long-term benefits cooking for you, your money doing other jobs, as it were, like whatever you want to call it. Yes. But why not just show the client on Front Street, like, this is your hurdle rate if you want positive arbitrage, because there is a way to get it, right? It may not be through the policy, but there is a way to get it. So now that we've unpacked the efficiency of the cash value, let's look at the fees. So scam likely. Scam likely is calling when we're looking at this policy. So what this is doing is it just isolates those negative years. Like we talked about this before, the 8218 is missing from the 90, then 812, 480, whatever. So it just quantifies it. It just says 9600 is not there in the beginning, right? So what's it do for you? Well, let's find out. What it does for you is it helps you pay less term insurance, a lot less in this guy's case. It creates ongoing tax sheltering on the cash value, loans, and death benefit. And it delivers a permanent net death benefit over and above. Like, even though you save money from term expires, there's a certain amount of net death benefit over and above the cash value that does not. So let's measure it. So what this is I told her, just to kind of summarize, do year 1, year 2, then every 5 years for while he's working. And we plug in a cost of the term insurance. We determine you pay about $850 for 500K. He was select. So it was like in between standard and preferred. So he was select. Not everybody has that. So we just kind of use this number. And then we took, here's the total death benefit. Here's the cash value. Here's the net death benefit. This is kind of like the term equivalent of what you'd be paying for that death benefit, right? Obviously, when he drops it, now here's his death benefit. Here's his cash value. He's only paying $189 at that same 850 rate. He's paying for less. So the cumulative savings, it's a lot, is $25,000. Now, if this guy cares about term insurance, and we have clients that do, like, this may be valuable. Like, yeah, you're missing $9,600, but you're saving $25K in term insurance. For a lot of people, it may not be valuable, but that's okay. The report can customize to what is important to people or not. So I can ask for a full year-by-year table. I didn't. I decided to move on to benefit number 2, that enduring death benefit. So whatever, he saved money from term, the term would have expired. He obviously has less death benefit at age 88 or year 35. He has $568 of death benefit, and he has $482 of cash value. You subtract those two, he's got $85K of net death benefit. And what did it take to create that? Well, he had $9,600 missing for him. Yes, it helped him recapture some term insurance, but we can say very clearly that, like, that early missing equity, this is what it bought him. It bought him a death benefit over and above his cash value. Didn't get to use it, touch it, whatever. Like, yeah, you can plan around it in retirement, but here's a death benefit that is like a guaranteed accounts receivable. And so it's almost like he took his $9,600, he put it in the insurance company's vault. They grew it at 6.47%, and they are going to deliver $85,000 to his heirs. Like, that's one way of looking at it. That's the way that I look at it. That is what I consider the compliant way to look at the early missing money that doesn't show up right away in a savings account for you. We already measured the efficiency of that savings account, what the actual money was doing, but what about the money that's missing? Now, what's interesting is if I said, hey, I got this great deal for you. I'm going to sell you an $85,000 burial policy. You can't touch it for 35 years. Just give me $9,600 now, and it's $85,000. That's like earning 6.47%. Would you do it? Most people would say no, and I agree. I probably wouldn't either. But when I tell them about the tax savings, in this case, it's worse. Usually it's not. It's just because this policy grows so crappily. I don't know if that's a word, an adverb for crap. But anyway, study period, study year 35, same time. Here's the cash value, 482. The total premiums paid were 241. The shelter gains happened to be 241, like 241 is 482. They're slightly different hundreds on there. So you avoided at 29.9% tax, you avoided paying $72,000 of tax along the way. Or put another way, your cash value growth was able to increase. Like you had a bigger bank by 72,000 as a result of having this tax saving, which is provided by the death benefit. So put another way, if I said to people, hey, look, the government's going to take money from your savings account, but you can pay $9,600 now to save $72,000 of tax later, even though it's a lower IRR, a lot of people would say yes. And usually it is a bigger number. That is Dee Dee Hutch, but I cannot take it right now, my daughter. Even though that is a bigger number, it's a smaller number. A lot of people would just, like I say, the tax tail wags the dog. People will do crazy things to avoid the tax man. But it doesn't matter what benefits you like best about whole life. You get them both. Old mentor James McGovern said that. I love that. Same study period, same year. You get an $85,000 death benefit. You get to avoid $72,000 on tax on the cash value that's supporting that. So the net death benefit plus the avoided tax is 157, created by the same 9633. That's like getting 8.36 for your money. So you may not like it that 9,600 is gone, but we can measure the efficiency of that. So anyway, I did a full summary here. What I did do separately, I'm just going to show you this. I said, AI, turn it into a spreadsheet. And like all the things are there. And I said, you know what? The font's too small. AI, do bigger font and give me under the summaries the key insights, because it starts making insights and some of them are quite good. And then give me the detail. So this is that missing equity. And what it shows is, remember, there were 4 years of missing equity, like you were missing the 8,200, the 812, the 400. With Philadelphia Life, happens to be Penn Mutual, we designed a much smaller policy that didn't need as much death benefit. So the premiums, instead of 90 and then 6 and 6 and 6, we did 25 and 25. The cash value added is only 19. So yeah, 5,200 ain't showing up on day one. The next 25,000 you put in, only 22 and changes there. So you're missing almost another $3,000. So you're only missing 8,100, but we can now measure like what you're doing. You're also saving less in term because it's not as big of a death benefit. So instead of this massive term saving, because he needed a massive term rider that dragged on the policy performance, you save some money in term. It's not the full 8,000 that's missing, but you know, if I told you could prepay for 15 years of term insurance right now, would you do it? Most people would probably say no. I'd probably say no, but it doesn't matter which benefit you like best. You get them all. Like this is less term insurance you'd have to pay. And there's the detail. Now, if we look at the IRR analysis and we look at the net death benefit, we already saw with the America Life, right? 85,000 of net death benefit. Well, with Philadelphia Life, you get 95,000, and it was instead of paying 9,000 to get it, right? You're only paying 8,000 to get it. So it's like getting 7.24. Here's where it gets really interesting. The shelter gains, you sheltered 241 from gains, which means you didn't have to pay 72K in tax, right? That's like getting 5.94 with America Life. With Penn, you sheltered 521,000 of gains. So you avoided $155,000 of tax. Now, that's starting to be a number. And sometimes people would probably do that. If I said, hey, look, you like, if people went to a bank like Chase Bank, and Chase Bank said, look, we got this new savings account. We're going to give you a better yield. It's protected from predators. And if you prepay us right now, 8,100, and now you get to avoid 155,000 of tax incrementally and just build a bigger tax shelter bank. And we're able to do that because we actually provide a service for widows and orphans. When people sign up for that account all day, every day, but since it's life insurance, they don't. But that's what I'm trying to quantify here is like, if you ask them, would you do that? A lot of people would say yes. And at 8.9%, that's a pretty good use of money. Well, guess what? You get them both. You get the 95K death benefit and the 521 tax savings, the 155 tax savings on 521 sheltered gains, right? So you get 251,000 of that combined benefit. Well, 8,100 to produce 251,000 of additional benefits for you while you're alive and your family when you pass away, that's like earning 10% on your money. And somebody had somebody from a carrier, I wanted to build this with a carrier in their software. And somebody said, Hutch, I don't think we can get that by compliance. I'm like, what? What do you mean? Why can't you get it by compliance? Well, you're saying they avoided all this tax. And I said, how about this? Tell them at age 85 or whatever, 88, to cancel their policy. And when they have 521 of gains over and above their basis, how much tax would they pay? Well, I guess you're right. I guess it's not a compliance issue. So yeah. And then if we go back to the cash value IRR, this is obviously simplified. And here's the year by year annual returns. They're just summaries. But anyway, it's all in here. And then it gives us kind of a final scorecard and everything else. But the whole point being is like I showed originally, I didn't like how the spreadsheet looked for me. And like, that's how a lot of our softwares we subscribe to are. Like, I wish it looked a little bit better. I just kept iterating between pouring cups of coffee or getting water or going to the bathroom. Or this is my new trick, by the way. This is a good transition to goals. When AI is thinking and I'm not getting coffee, I force myself to hit the deck and either do push-ups, planks, or sit-ups, scissor kicks, something, because I've never had abs before. And I you're not going to see me like, right? But like, it would be good. Like, I'm getting to the point where it's like, bro, come on. So I'll go ahead and take a couple questions and then we'll pivot to some stuff. Yeah, every new idea is non-compliant. Yes. Yeah, let's keep going. Oh, softball question he puts, why should people work with Banking Truths? Well, why people should work with Banking Truths is because this is the mission of our company in 2026. We are not like, instead of just putting just verbal information and some video case studies occasionally, we are going to be using AI to give you what used to take us forever with Excel, right? Or buying software and just like forever to kind of tinker around, to give you the optics you need, the dashboard you need, the analysis you need to understand what is happening under the hood of your insurance policy. We use only the highest quality products from the top performing companies. And we are happy to model that and do the Pepsi challenge against any of them and explain to you just the soft benefits why, because sometimes it's not just about hard numbers. Maybe it's about flexibility. Maybe you do want a true long-term care rider. Maybe you do want chronic illness. Maybe you do want direct or non-direct. Whatever it is, we are independent brokers. We're going to come correct with top quality products, but also we're going to give you the optics. Like, I talked to a gal the other day whose husband had all these RSUs from a very reputable company that shall remain nameless. And, somebody, they wanted to pay tax, and some agent had showed them like cashing out 401ks and paying tax and selling other stock to put money in a policy to borrow against it to pay the tax so they can have unencumbered stock units. And we showed her that she was way better off putting her money in a coffee can. So at least stopped her from doing anything bad. And now they're understand 4D banking, especially since they have a lot of stock and are in the process of just starting the whole discovery process from scratch. Probably will result in a smaller policy than what was showed before, but that's okay. Thanks for the softball question. Plug away, Hutch. All right, so let's actually, I'm going to show you one more thing, and this isn't perfected yet, but before we do the agent thing, this is the borrow analysis, and it is annoying me. But essentially, it's like this. We do a very in-depth, a very, let's just say, heavy borrow situation where we're just like, we're funding a policy, we're borrowing during the periods, but borrowing, paying back, a lot of different loans and paybacks, but we're really trying to stress test it. Why did it do these stupid lines? I don't like it. But at any rate, we tested it with some alternative loan rates. In addition, it's not showing the policy loan, but the policy loan was less. The policy loan was like 5 point something. Like, essentially what this is showing is if they did a cash value line of credit of 5.75 nominal with no deduction, They would need 6.74 to like just save and pay cash and spend cash and save and pay cash and spend cash. And there was a buy term invest a different component. Like I'm not going to show you under the hood right now, but like you can plug in whatever variables you want, but this is what rate they would need to equal the borrowing scenario. What's interesting is if you can deduct the loan, and that's up to them, but we're showing the optics that if you can deduct the loan, making the effective rate instead of 5.75 at 37%, making it 3.63. And obviously it is reflected as a credit, and I'm sure I can train AI to show that the next year. But just for simplicity's sake, now you need 9% to equal it. A margin loan, a lot of our clients do have stocks in stock portfolio, whether it be employer stock or whatever. Robinhood right now, $50,000 loan or more, 4.75. You get down to 4.5 after I think it's 250 or whatever. But if you just did a nominal margin, non-deductible margin loan, and borrowed against the same policy loan, like the same cash flows, and just use the policy as a backup to the margin loan, now you'd need 8.2% in a savings account to whatever, stock up a savings account, spend it, replenish it, spend it, replenish it, buy term along the way. You need 8.2. And if you can deduct the margin loan at 37, and even though stocks often are long-term capital gains, which by the way, we can model, the client also had rental property. So if they have rental property, they can take any investment interest and deduct it against any investment gains or proceeds. So if they can deduct it at 37%, now the 4.75 margin loan is really 2.9. It's 9.3%, which is pretty cool. And this just shows like what the nominal cash value grows to. AI, it makes mistakes sometimes. I told it when it's under $1 million, call it 660K or whatever it is. But it just shows like what the cash value gets to with the different things. So this will be fully unpacked. And I believe, hold on just a second. I don't have the actual, like, this is from our old software. We took this from our old software and dumped it in here. Let's hammer through the goals and some AI real quick. So let's throw it in here. Long day. I was actually on a podcast early today. All right. Here we go. Okay. Hold on. We got a Q&A. The AI analysis and insight into returns is really interesting. Is that something your customers can access if we upload our policy illustration? Yeah, Matt, right now you can access it through us. So unfortunately, and this is what I'm going to get to, we tried to build it public through ChatGPT. ChatGPT just would not follow directions. Oh, wait. Oh, no, not from the beginning. Come on, guys. Come on, guys. Apologies. This is material. The slide is material to me answering your questions. Question, Matt, not from the beginning. So tried really hard with ChatGPT. By the way, I have ChatGPT, the business teams version, and I also have Claude, the business teams version. Claude, you need 5 seats. ChatGPT, you don't. But ChatGPT is interesting because you can get public GPTs that I could just give to the clients. I could not get it to follow the directions. And I would say, you're not following directions. Oh, you're right. Good catch. Great observation, Hutch. Like my daughter loves to say, oh, Dad, is ChatGPT glazing you again? And it does that. Like they did it on purpose. They actually did a study where, forget which one it was, when they went from 3.5 to 4 or 4 to 4.5. They made it less glazy, for lack of a better word, and that people didn't use it as much. They didn't like it. Like they like that warm and fuzzy. My buddy's an engineer and his wife's a doctor, and we were talking about this. She's like, I love ChatGPT. It gave her the warm and fuzzies, right? So it just wouldn't follow directions. Yeah. So like people worry about AI going rogue. I worry about ChatGPT. So Claude is what we're doing. So it admits its mistakes. It also shows, like ChatGPT says thinking, and sometimes it'll scroll like little messages like, I'm doing this. Claude gives you a drop down so you can see. And so if it does it wrong, you can kind of go back and show it with its work. I just ask it. That is probably the coolest AI hack, is just ask AI how to do AI better, but way less likely to hallucinate or fabricate. And it doesn't always follow directions like you saw, but it will. This is my favorite AI meme. Is this mushroom edible? AI, yes. The next scene, guy's dead. You're right. The mushroom was poisonous. I'm sorry for the confusion. Would you like to learn more about poisonous mushrooms? That's literally what using ChatGPT felt like. I was so frustrated. So unfortunately, Matt, right now everything's on Claude and it's with Claude projects. And since we're on Claude teams, it can only be shared to people who, like, if you had Claude, you would have to have a Banking Truths email address to have one of our Claude teams. But your agent, Ben, can get you an analysis. So just talk about the scenario you want to do, refine that with him. And it's been great because I've been wanting to get the guys to practice on this, and that'll get them to practice. So, yes, the answer is yes. And then eventually, if I can find a way to do it on a public chat GPT, I would absolutely do it. We must quality control AI. So yeah, it should amplify expertise, and it does amplify stupidity too, or it amplifies overlooking mistake. It's like compound mistakes will just keep going through. Experts should be the ones to drive AI. Blindly trusting AI's output, it can be very dangerous. So again, if I could trust it to follow directions and stop itself, and Claude is known to be a very compliant mode. If they had public GPTs, it probably would be public right now. But at this point, no. And so this is our team, myself, Ben. He looks really young. He still looks young, but he's 42 now. But there he looks like he's like 28. But that's when he was 27 when we both started. Brian and Matt Sanford. So yeah, and I just use this. Please, Hal, open the pod bay doors. Like this is from the 2001, and how the AI saw like him and another human, Dave and the other human, went into a place that Hal couldn't hear, like a time lock, and they talked about disconnecting him because they realized that he was too powerful. And Hal read his lips, and then Dave was trapped out in space, and he wouldn't let him in. And of course, like I won't spoil it for you, but anyway, that's very, very scary what can happen with AI. This is a really cool hack. Projects. So whether you're using GPT or whether you're using Claude, the more you put into the chat, it only has so big of what's called a context window, and that hogs a lot of context window. But if you put the exact same thing that you put into the chat, if you uploaded it into a Word doc or PDF, it doesn't, into a project file, it doesn't count against its context window. But I still put, or Usher says no to Word docs and PDF because there's still too much clunkiness. There's still too much formatting and headlines and whatever. It's still too bulky of a file. And if you can get that onto what's called a plain text file, I do that for transcripts because it's just like there is no formatting. It's just like stream of consciousness. This hardly uses anything. Like if you just look at WordPad, that's .txt. And MD files are actually TXT files, but they do have some formatting. Like they do indents, and they do certain like number signs or hashtags to indicate the formatting that you'd want to see. But since you're not looking at it, you're just feeding it to AI. This is a more efficient way to do it. So I use Markdown files instead of Word or PDF. Before I tell you about MarkSnip, how to do it is Google Docs is great. And by the way, we're going to be doing this with our clients and old clients and new clients going forward. When we do client reviews, we're going to start to transcribe the old notes we had from Microsoft OneNote, put them on Google Docs, share them with our team, share them with our clients. When we do new proposals, clients can comment on that within the Google Docs. And rather than, nobody has time for meetings, like eventually you do when something's big, but there can be a lot of back and forth that happens at the Google Doc level or the Google Sheet level, especially with some of the stuff we're doing with AI can be uploaded into Google Sheets. So that's definitely the way we're moving. But with any Google Doc, like you can upload a PDF, or you can upload a Word doc into Google Docs. And then when you go over to the file and you go download, it gives you a bunch of file types. One of them is a Word doc or a PDF, but you can choose TXT or Markdown. And so if there is formatting and headers, it is better. It takes up a little bit more space, but not much to do Markdown. And that kind of cues AI like, oh, this is a header, so we're changing gears here, or this is important, or whatever that looks like. And if it's just a transcript, I just use the .txt file. This MarkSnip Chrome extension is awesome. It's free. You put it on your Chrome and just kind of have it up here. So you can go to any web page and just go MarkSnip, and it just turns the whole web page into a Markdown file. Like So I'm going to talk about how I'm using it. Simple text files, better AI performance. You preserve your context window. So you want to have those chats and you want to preserve those chats for the content window. Excuse me, you want to preserve the content window for lots of chats. And so you just kind of pre-stock the pond with intelligence and memory with these files. This is how I use each model. ChatGPT, when I want to make public custom GPTs, I probably will, if this recording goes through, I probably will upload the transcript with timestamps to a public GPT, and then I will send out the replay as a video, and there will be timestamps on the transcript, which will be fed into the GPT. So you could ask the GPT to summarize it. You can explore different parts that you want to learn more about. It can give you timestamps, and if you want to go back and surgically watch that part of the video, do that. That's how I'm using. I hardly watch videos or webinars or read full web pages anymore. This is what I'm doing. The problem with ChatGPT is just too much fact checking and trust issue. Like I just don't trust it. Like it is a bullshit artist. Like, excuse me. It like literally will just try and sneak stuff past you. They call it hallucination or fabricating. And like you can put in the instructions, don't hallucinate or fabricate. It'll still do it. You can say in the project files, do this, not that, and it'll still do it. And it'll say, oh, good catch. You're right. I did do it. I won't let that happen again. And it does it right again. Claude's my main go-to for writing, coding, and researching. That's the good part. The bad part is it doesn't crawl certain sites like ChatGPT does. So ChatGPT, OpenAI had to deal with Reddit. And like I noticed, like I'm into jam bands. And so I was like to Claude, I made a project like go crawl like a jam base, setlist.fm, fish.net, Reddit forums for these different jam bands, all these different jam bands, all like Eggy Goose, Dead and Company's No Longer, J-Rad, all these, and go crawl. And like, I would just ask about certain shows or songs, or when's the last time they played this song, or what are fans raving about. And Claude just said like, oh, they changed, this site changed it to where they don't accept robots asking it for information. But I do the same thing in GPT and it does. So, and it's because they're paying off Reddit and stuff. Perplexity, I like it for, first of all, going back to preserving content window, I'm on paid ChatGPT and paid Claude. Claude will throttle you. Like they will just straight up say, like you, even if you're on the paid account, like you hit your limit for this 5-hour window, and they do it in 5-hour windows. This is one of my hacks, by the way. Like I wake up and I just ask Claude to do something, because then I start my 5-hour window. And that way, if I bump to the end of it 4 hours later, I only have to wait an hour before I go again, or before I have to upgrade my account, or you can connect a credit card and pay a la carte. People are like, oh, I like ChatGPT better because it does that. But what I realized ChatGPT is doing is they don't openly throttle you because they're trying to glaze you and give you a good user experience. They just replace like Einstein answering your questions with like a 10th grade stoner bullshit artist. Like they're throttling you. They're just not telling you they're throttling you. It just starts making crap up. It's kind of like if you go overseas and like you pay for the plan where you get a certain amount of 4G, and then all of a sudden now it's like, oh, now you're on 2G. Like it does that. It just doesn't tell you that. Claude will straight up tell you like, okay, you're done with 4G right now. So I like Perplexity when I'm just doing like googly or heavily googly kind of stuff. I use Perplexity. For projects, it just the output wasn't as clean. But when I just want answers and some deep research, I like it, and it preserves my contracts window. Gemini can also be good for that. I just found the AI mode, and I'm sure it's always improving to not to be as good. But yeah, it's probably getting better. Gemini, their picture thing is the best. It used to be ChatGPT was the best for pictures. Right now, Gemini is, so that is worth trying. And if you have Google Business Email, you have a certain amount of kind of free Gemini anyway. Grok, I use that for real-time investing, news, conspiracy, like anything that's like very timely. I like Grok because just like ChatGPT paid Reddit to train on all that stuff, Grok, Twitter has it for free, or X, whatever, has all that for free. And so it's like when I want to know stuff real time, what's happening, I go Grok. And apparently their video is very good. I have not been using it as much. it's bad. I don't know if it can now, but back then it couldn't even upload files or make projects. But there you have it. So learning, I talked to you about what I do for learning with the websites. I do this with YouTube videos now. So like I transcribe YouTube with timestamps. And how I do that is this speechgen.io. You have to pay. Where's the there's the cost. So I paid for the $50 thing. And what it works out to be is it works out to be like 80 some cents per hour of video. So I have another software where I don't have to pay that, but I have to like download a video and then upload a video to this thing and then press a bunch of buttons and tell it to do a transcript. And with this, like it says insert YouTube link. I just put, if it's on YouTube, I just put a link there. I use that other thing when I have like actual videos. Like sometimes if something's not on YouTube or I watch a webinar, and here's a great hack, and I realize I do webinars, but like if I was one of you guys, because I'm gonna like spoon feed it to you, but like, and I didn't want to watch the whole video, I would use my screen record to watch the video for me, put the sound on one, go do whatever I'm doing, watch the video for me. Then I would create that video, do a very low quality video, like 480 or whatever, and then upload that into, I have Descript where it makes a transcript. And then I would produce it to my own YouTube Unlisted. I do it at like 1.5x speed, just so I have like something just on here I could just reference real quick with timestamps. And then the transcript, I put timestamps, and then I just upload it into a project, and I just start asking a question. Summarize this. Oh, well, tell me more about that. What did he say? Oh, cool. Where's the timestamp where I want to go do it? And what's the public link? And I just, boom, I do it. I'm going to do that for you with this. But if stuff is on YouTube or you're watching a lot of stuff on YouTube, this speech gen is amazing, right? Just have its AI summarize the content for 80 cents an hour. Ask us specific questions. So like, here's something cool. Like this just overlaid, right? You can't see it, but it's 27 hours, very, very small. So this is a screenshot of all my history on it. And I said, hey, tally how many minutes or hours I've used so far. And it's like total runtime. I've done 27 hours, right? Here's the views. And I paid for the whatever. Like I use a little over half my plan, but it's like, it's amazing for 80 cents a minute. I'm probably going to pay for the expensive plan. Here's another use case. I sometimes, when I'm driving or I just like, I don't want to take notes, I'll just babble into voice notes, or I can turn on YouTube and I can just babble into it. Right. And like, you could just produce that to YouTube and then have it transcribe it for just like my own ideas, transcribe with AI. If you want to try different transcriptions, like you want to try your like voice note and see how good it transcribes, like you could just, you do that and then use like a good transcriber. Like SpeechGen is pretty good. That Descript that I use is even better. You got to subscribe to both of them. But I put like, okay, what did just my voice notes do compared to that? And I asked where there was ambiguities, and there was enough to where I was like, you know what, I'll pay the 80 cents as opposed to just whatever the free Galaxy AI I have on my thing. All right, so here is the coolest hack, I think, for setting goals and sticking to them. So people call using AI as like a thought partner, or a second brain or whatever. I call it the concierge. And I don't know if you remember this. This is from the movie The Godfather. What is the concierge? It was Tom Hagen, or it was what's his name? He was from Apocalypse Now too. I can't think of his name right now. Oh, somebody please put it in the chat. But I love the smell of napalm in the morning. What's his name? Anyway, what is the role of the concierge? AI overview. This from Google. A concierge is a trusted advisor or counselor to the leader, Don, of a mafia crime family, serving as a strategic counselor, confidant, and mediator, forming part of the ruling administration with the boss and underboss, and offering objective advice, even challenging the boss's plans to make them foolproof. They provide experience, insight, and are crucial for managing internal and external affairs, often acting as a neutral diplomat or right-hand man without directly leading soldiers. I love that. So I have built my own concierge, and I think somebody put in the Robert Duvall. Yes, of course. And AI did a good sketch job, if you guys remember that scene. So how to build your own thought partner or concierge. So babble into voice notes. When you're driving, when you got time to kill, just start babbling. Doesn't matter. It's LLM, large language models. Just start talking about what you want. Transcribe with AI. Okay. I did the wrong bullet. So I'm just going to tell you, just start talking about what you want, what you don't want. Talk about the context. Talk like have us. I had a separate one. Like, here's my family. Here's my family situation. Right. Here's what we're about. Here's where we're going. Here's what so and so is doing. Here's what so and so. Here's my dynamic with so and so. Here's my dynamic with so and so. Like your marriage, that could be its own thing, right? Your friend life, your work life, your friend, like your professional life, just you and your profession, and you with the social aspect of the people in your work domain. You can make business plans, ideas, and ask it. Like you can put the instructions, like take my context, but also challenge me, be my concierge, so that like you could actually just use that as a prompt. Like literally, I think I actually may change it to include this now that I mention it. But that is very, very cool. So I wanted to share this with you guys because we are into January. Some of you may have started with some resolutions that are already gone or already gone out the window. And maybe you just need a little kick in the pants to get back on the horse. This is what I learned. It was a study by a bunch of academics. So academics studied, I want to say like 27 different academic studies that focused on athletes and goals with professional or collegiate athletes. And this was posted by Vlad Tenev, the CEO of Robinhood. And what the study said is that process goals were more likely to stick and succeed than progress goals, which were more likely to succeed than outcome goals. And to give you an example, like outcome goals, like I want to win the Super Bowl. Well, that's great. And it's great if there's only two teams left. And obviously there's things you can do, right? Like you can say, like, by the time this happens, I want to be running an X minute mile. I want to be, whatever the metric, this progress metric is. But you can focus on the process. Like, I'm going to do X per day. And like, certainly at the beginning of the season, what they found is these outcome goals, they hardly ever come true. But they were more likely to come true. And these were more likely to get stuck to. Like, this was more likely than this by like infinite. It was a really big number. And that this was more likely to stick than both of these, like by magnitudes more, but also they were more likely to come true because you're sticking to it, but they were more likely to make these come true, is what I gathered from the study. So I start with what I want and what I don't want. I reverse engineer the steps to get there. I ask AI to help me do it for me, because it's like you have this lofty goal, right? And people think it's a straight line, but it's not. It's like that picture. It's like peaks and valleys and pitfalls and whatever, everything else. But ask AI to help reverse engineer the steps, and ask AI to help give you a process to follow, like this week. Like, what do I do this week? Focus on the behaviors. Like, that's what I do, is I focus on the behaviors and the attitudes needed to achieve these things, right? And I try and anchor my new behaviors to old habits, because old habits do die hard. So again, like it was, since the new habit is I'm doing a lot of AI and it pauses, I could sit there and I could stare into space. I can doom scroll. Sometimes I do go get coffee or a snack or go to the bathroom, but a lot of times I'm not in between. And so just those little things has already helped me, just like doing the push-ups and scissor kicks and crunches, like just doing that when AI is thinking has helped me lose, a decent amount of weight, and I don't feel like I'm suffering. And you can stay accountable with the humans, by like declaring what your goals are to them. Or if they're really, really private, you can just stay accountable with your AI concierge. So anyway, I just wanted to share those tricks. And then the last thing is, everybody says they're busy. Before you focus on this, I should have had it animated. Try being president and general of a world war. Actually, Eisenhower, maybe it wasn't a world war. I'm sorry. Like, I feel very stupid now. It could have been the Korean War. But dude was president and fighting a war, like being not only commander in chief, but like out the general directing. So anytime you say you're busy, like I tell my kids this, right? Like, I'm busy, like, stop. Really, please just stop. Right. But even me, like thinking about Dwight D. Eisenhower. So he made up this matrix, and it's made up of these two, like these are urgent, these are not urgent, and going across like this is important, this is not important. And so let's just walk through what that means. So you have to ask what's urgent and what's really important. So like urgent is like if you have a health scare or whatever, and like that is urgent and it's important, like yes, you have to do that first. If it's April 14th and you are committed to doing your taxes on time, that is now urgent and important. Sometimes you get something from your boss or whatever, like it's urgent and important. You have to do it. You have to do that first. Um, but there's a lot of stuff that's important that is not urgent. Like if you don't want to end up, if I don't want to end up at the hospital, like I'm pre-diabetic, I'm not pre-diabetic, but I'm pre. So if I like, it's not urgent yet. And if I don't want it to be urgent, I better make it important and I better decide and schedule or start anchoring new behaviors to old habits so that this thing that is important to me does not become urgent. But since it's not urgent, most people, this just dies. Their dreams die, their goals die, sometimes they die. And unfortunately, where most people's time goes is down here to not urgent, not important. And a perfect example of that is doom scrolling. Social media, especially, it pacifies us, it gives us a dopamine, it fills any gap anywhere at any time. And it may make us like we could say we're doing research or whatever, but if you know when you're doom scrolling, but if you recapture some of that time, you delete that, just drop it or do less because it is not important and it is not urgent. I have a horrible habit of over checking my inbox. And so now when I'm doing focus work, I will just click X and get it off there. I'm not going to let myself go there. Put on headphones, I listen to some music and I get some work done. I do my crunches in between, whatever. But somebody, it was a marketer actually that told me that your inbox is really just a list of other people's agenda for you. So it may be important to them, but it's not necessarily important to me. And it's certainly not urgent. This is what I hate. I am a horrible texter because text, I don't do notifications, either sound or the drop down. I do not do it. Why? Because text is turned into when people send a text, they may as well be like right in your face. Like they expect an answer now. Why? Because they send a text. Like in what universe did we go from like the Pony Express to like this is like the highest priority means of communication? I'm sorry, I'm opting out of that. Like I will text, but I force myself to check text when I feel like checking text, and then I try and catch up on all of them. But most texts, most inboxes are not urgent, not important. And that is something that can be delegated, right? And I am trying to just get AI to do as much as possible. Never been a huge fan of employees. I never got into the VA virtual assistant. Thought about it, talked about it, like, okay, I could do the Philippines and, talk to somebody and yeah, you can trust them, but I'm in the financial, like, just never really got there. But like the AI virtual assistant, like, okay. So it's urgent. Like it needs to be done, but it's not my highest and best use. Thankfully, I have some team members. I have some contractors that I can delegate this to. I realize not everybody has, but AI is amazing that you can absolutely do this. So let's get to the bullets. So yeah, what can you delete, delegate to now? And this is the bonus right here. Like like go through your concierge and figure out what's important but not urgent and what's getting left behind, and then go through this Eisenhower Matrix and figure out how to reprioritize your life. Add to Claude for context, the concierge. That's it, guys. I will stay on and I will answer some questions if there are any. We still have 30 people here, which is pretty cool. Yeah, we did it in 90 minutes. I realized I talked very, very fast. Most people are going to watch this on high speed anyway. So they won't have to. They'll only have to do like 1.1 speed for me. It doesn't look like there's any questions or any chat. So I'll give it another few seconds and then I'll let it go. Yeah, that's Drake. Yeah. By the way, I love the memes. So I have teenage kids, and memes are a great way to get in touch with your kids, and learning how to make memes. You will be like the cool person on the family chat. That's it. Hope you guys enjoyed it. Talk to you next time.